The United States economy, like any other, experiences fluctuations in growth, employment, and inflation. To minimize the severity of these fluctuations and maintain economic stability, policymakers rely on two primary tools: fiscal policy and monetary policy. Government spending and taxation. Fiscal policy refers to the government's use of spending and taxation to influence economic conditions. The government can use these tools to stimulate economic growth during a recession or to cool down an overheating economy. When the government increases its spending on goods, services, and public works, it directly injects money into the economy. This increase in spending can lead to higher aggregate demand as the government's purchases stimulate production and employment in various sectors. For example, if the government invests in infrastructure projects like roads, bridges, and schools, it creates jobs in construction and related industries, which can ripple through the economy. Taxation is another powerful fiscal policy tool. By adjusting tax rates, the government can influence the amount of disposable income available to consumers and businesses. Lowering taxes leaves more money in the hands of individuals and companies, which they can spend or invest, thus boosting economic activity. Conversely, raising taxes can slow down the economy by reducing the available funds for private spending and investment. Fiscal policy. Depending on the economic situation, policymakers may employ either expansionary or contractionary fiscal policy. During a recession, the government may pursue expansionary fiscal policy by increasing spending and or reducing taxes. This approach aims to stimulate economic growth and reduce unemployment. On the other hand, if the economy is growing too quickly and inflation becomes a concern, the government may implement contractionary fiscal policy by reducing spending and or raising taxes to cool down the economy. Monetary policy is another critical tool for economic stabilization, managed by the country's central bank, the Federal Reserve System, Fed. The Fed is composed of the Federal Reserve Board in Washington, D.C., and 12 regional Federal Reserve banks across the country. The Federal Reserve Board, consisting of 7 members appointed by the President and confirmed by the Senate, sets the overall direction of monetary policy. The regional Federal Reserve banks implement these policies and supervise commercial banks within their districts. The Fed has several tools at its disposal to influence the money supply and interest rates. Open market operations. The Fed buys and sells government securities in the open market to control the money supply. When the Fed buys securities, it injects money into the economy, increasing the money supply. Conversely, when the Fed sells securities, it removes money from circulation, reducing the money supply. Federal funds rate. The federal funds rate is the interest rate at which banks lend money to each other overnight to maintain their required reserves. The Fed sets a target for this rate and uses open market operations to achieve it. A lower federal funds rate makes borrowing cheaper, encouraging spending and investment, while a higher rate has the opposite effect. Discount rate. The discount rate is the interest rate the Fed charges when it lends money directly to banks. By adjusting this rate, the Fed can influence the cost of borrowing for banks, which in turn affects the interest rates they charge their customers. Reserve requirement. The reserve requirement is the portion of deposits that banks must hold in reserve and not lend out. By changing the reserve requirement, the Fed can influence the amount of money banks can create through lending. The Fed uses these tools to pursue either expansionary or contractionary monetary policy, depending on the economy's needs. During a recession, the Fed may lower interest rates and increase the money supply to stimulate borrowing, spending, and investment. This approach is known as expansionary monetary policy. Conversely, if the Fed is concerned about inflation, it may raise interest rates and reduce the money supply to slow down the economy, a process called contractionary monetary policy. While fiscal and monetary policies operate independently, they can have significant effects on each other and the overall economy. Ideally, Fiscal and monetary policies should work in harmony to achieve economic stability. For example, during a recession, the government may implement expansionary fiscal policy by increasing spending and cutting taxes, while the Fed pursues expansionary monetary policy by lowering interest rates and increasing the money supply. This coordinated approach can provide a stronger stimulus to the economy than either policy alone. However, there may be times when fiscal and monetary policies are at odds with each other. For instance, if the government implements expansionary fiscal policy while the economy is growing rapidly, it may lead to inflation. In this case, the Fed may feel compelled to pursue contractionary monetary policy by raising interest rates to control inflation, even if it slows down economic growth. Another potential conflict arises when the government implements fiscal austerity measures, such as reducing spending or raising taxes to address budget deficits. These measures can slow down economic growth, prompting the Fed to pursue expansionary monetary policy to offset the effects of fiscal tightening. Given the potential for conflicts and trade-offs, the right mix of fiscal and monetary policies is crucial for achieving economic stability and growth. Policymakers must carefully consider the current economic conditions, the potential impact of their actions, and the need for coordination between fiscal and monetary authorities. Stabilizing the economy is a delicate balancing act that requires the skillful use of fiscal and monetary policies. By understanding the tools available to the government and the Federal Reserve, as well as the potential interactions between these policies, students can better appreciate the complexities of managing the U.S. economy. As future voters, taxpayers, and participants in the economy, it is essential for students to grasp these concepts and their implications for economic stability and growth.